a stock that has clearly outperformed the markets, whether you take a 1 year or whether you take a 3-month IDFC. That's the stock in focus today, up today as well by about 0.7%, and recent news that they can raise infrastructure bonds make them even more attractive. Let's speak to the management. Vikram Limaye, Executive Director of IDFC, joins us to talk about just that. Vikram, that's the point. How do things change for you after this permission to grant to issue infrastructure bonds? Will it make the cost of capital cheaper? And firstly, of course, will you issue them anytime soon?
So a couple of points on that. I think just broadly speaking, the announcement surrounding classification as an infrastructure NBFC and the recent announcement surrounding the ability to raise tax-free infrastructure bonds actually achieves a couple of different things. One, it clearly diversifies our liability franchise and gives us additional avenues for raising resources, whether it's the retail landscape for infrastructure bonds or whether it's access to ECBs, which, as you know, for infra NBFCs, there's automatic access to external commercial borrowings up to 50% of net worth. So these are two avenues that so far have not been available to us from a resource raising perspective. And so it's an important development for us in terms of diversifying our liability franchise. As it relates to the specific cost of borrowing surrounding these two avenues, on the ECBs, as you know, it's all a function of what's going on in the international markets and on whether on a fully swapped basis the external borrowings are cheaper than domestic borrowings. Currently, I think it's more or less a wash, so I don't think there's any significant cost advantage in borrowing offshore and swapping fully into rupees, but there is a clear advantage in terms of having an additional avenue for borrowings. For the retail tax-free infrastructure bonds, the notification says that there's a cap on the interest rate for issuers to be the equivalent of the GSEC rate. And so from that perspective, clearly it would be an attractive cost of borrowing for issuers. And on a normalized basis, when investors actually look at the normalized yield, taking into account the tax break that they would get on this, it should be an interesting rate for investors as well. So it should be a win-win.
Vikram, if you can put that as in terms of numbers, for instance, what the 10-year is now at 7.665%. What would be the cost to an investor? Why would he want to put at 7.6 return?
If I were to do a very simplistic calculation, and actually we're trying to think through this internally ourselves, but if I were to outline a methodology and I was to say that an investor putting 20,000 rupees into a tax-free bond gets a 20,000 rupee deduction from his income for tax purposes, the impact from a tax perspective is 30% of that. So if 30% is the benefit spread over a 10-year bond, then you're on a simplistic basis, without taking into account present value effects, etc., you're talking about, say, a 3% benefit. And if you add that to any kind of cost on the bond itself, whether it's 7.6, 7.5, whatever it is, on a normalized basis, you're looking at 9.5-10% yield to the investor, which for a AAA entity like IDFC, I think is a pretty attractive yield given the credit risk that you're taking.
Vikram, there's a brokerage report which says that the total market for these bonds could be 8,000 to 10,000 crores. Would that be a fair assessment, and how much would be your target in that case?
It's early days, so we haven't really done a market assessment of what the appetite of investors would be for tax-free infrastructure bonds. So I don't have a view on whether the size of the market is 8,000 or 5,000. In terms of our own capacity, based on what's been outlined in the notification, our gross disbursements to infrastructure last year, because this is based on what you did in fiscal 10, was about 12,000 crores. So 25% of that would be 3,000 crores is the amount that we could issue based on the notification as it stands today.
Can you give us a big picture idea as to how much your cost of capital has fallen? For instance, say 6 months ago, you did not have either of these infrastructure status or the ability to issue infrastructure bonds. Now you have. How much would your cost of capital have fallen?
Well, it remains to be seen at what rate we are able to issue these bonds and the quantum, etc. Because the average cost of borrowing for us is a function of the composition of our liability base, right? Between bonds, between loans, between ECBs, between the tax-free bonds, etc. And what the cost of issuance of each of these instruments is. So the overall mix of our liability franchise would determine the average cost of borrowing. I think, broadly speaking, as you know, the AAA spreads over the government have been declining. They've now inched up again over the last month or so, but at least till about a month ago, the AAA spread over the government was more like 70-80 basis points. Now it's more in the region of 100 to 120 basis points. But 12 months ago, it was 150, 170 basis points. And as you know, a couple years ago, it was as high as 350, 400 basis points. So for quality issuers, typically, AAA, because we're a AAA, the average AAA spread over the government has been declining over the last couple of years. And so we'll see how, at what rate we're able to issue these tax-free bonds. And the average cost for us would be a function, as I said, of the overall mix of our liability franchise.
Okay. Vikram, a couple of quick questions. Are you all now pretty decided that you all will not want to use the option even if you all were allowed to take a banking license?
Yeah, as we've said, we're not pursuing a banking license at this time because our conversations surrounding banking had to do with how we address the liability side of our balance sheet, had nothing to do with our interest in issuing consumer loans or credit card loans, etc. So given our infra finance NBFC status and some of the recent regulatory changes surrounding tax-free bonds, and we're quite optimistic about the fact that now that we have a differentiated category, incremental regulation will favor infra financiers going forward. So we certainly hope that incremental regulation that gets created will benefit this category. And so to that extent, it does address our liability side issues, which was the main reason why we were in conversations surrounding whether a banking license made sense for us.
Just give us an idea of how much your margins are likely to expand this year. You have a lot of your QIP money with you, 2,400 crores thereabouts, and of course you have access to more funds if you need. How much will margins improve by in FY11 over FY10?
Again, it's very hard for me to give you a number right now because it's early days and we are in a rising rate environment. And again, our margins are a function of multiple things. It's a function of our own cost of borrowings. It's also a function of what happens to asset yields in infrastructure financing and what the demand for infrastructure paper is relative to, the capacity within the system to lend to infrastructure. So it's a complex set of variables that feed into what our ultimate margins would be on the infra lending business. I think what I can say is a couple of things. Our historical experience has been that through a rising rate environment cycle, our spreads tend to expand. Our historical experience has also been that in the early stages of a rising rate environment, you could see some spread compression if your borrowing costs adjust faster than the asset yields adjusting. There could be a set of dynamics going on in the marketplace today which could cushion some of that impact based on recent announcements, as well as the fact that if overall credit growth does pick up and the constraints that the system has to certain sectors in infrastructure, asset yields could actually held up okay and therefore spreads could sustain rather than compressing in the near term. But we are not seeing any kind of serious spread compression at this point.
All right, Vikram Limaye, thank you very much for joining us.